Good day, everyone. Thank you very much for joining us for this RCI POD webinar titled Capital Flows During COVID-19 Pandemic, Insights from Sectoral Capital Flows and Policy Challenges. With rapid financial globalization over the past few decades, Asia's cross-border financial transactions have increased substantially, as we all know. Free capital flows help to allocate the savings for productive investments and promote growth around the globe. However, volatile capital flows can lead to a number of potential problems, such as volatile asset prices, sudden reversals, sharp exchange rate movements, and risks of financial contagion. When they do, they undermine economic and financial stability and weaken growth. Not to mention, recent trends in financial flows to the region have reflected uncertainty around the ongoing COVID-19 pandemic. Especially in March, we saw sudden portfolio outflows from the Asian Pacific region. These movements were of greater size and speed than during 2008 global financial crisis or 2013 taper tantrum. By May this year, portfolio flows returned to the region, but the vulnerabilities remain, amplifying the risk of repeated sudden stops in capital flows or a rise in borrowing cost. These vulnerabilities include weakened economic prospects, increased fiscal deficit, elevated debts, and considerable foreign holdings of domestic debt. Maintaining financial stability calls for underlying dynamics of capital flows and the types of capital flows to be understood. Authorities often consider different types of cross-border flows and also different modalities. For example, they look at equity, bond, and loans flows as volatile. But equally important is knowing which sectors they are coming from and to which sectors they are going. This sectoral approach allows understanding of evolution of capital flows to and from the banking, non-bank financial, public, and non-financial corporate sectors. It also suggests how sectors respond to changes in global and domestic financial conditions and risks. So today's RCI POD webinar will cover these topics around the sectoral approach of financial flows. Rogelio Mercado, or Roger, will begin by examining recent capital flow trends in the region. Roger is an economist, just arrived at the ADB, at the Regional Cooperation and Integration Division of the Economic Research and the Regional Cooperation Department at ADB. Roger and his co-author, Etienne Leparts, will then present details of their recent paper titled Sectoral Capital Flows, Covariates, Movements, and Controls. Etienne is an economist at International Finance Unit of the Directorate for Financial Affairs at OECD. Following the two presentations, Sin-Yong Park, Director of ERCI, Economic Research and the Cooperation Integration Division of the ERCD, Economic Research and Regional Cooperation Department at ADB, Sin-Yong Park is a director, will moderate a panel discussion with two distinguished speakers. With us today we have Professor Frank Warnock, Professor of Business Administration at University of Virginia, Darden School of Business. Frank is an expert and authority on international capital flows, international portfolio allocation, and financial sector development. His work has been featured in various very top tier journals, various publications, including American Economic Review, AR, Quarterly Journal Economics, a Review of Financial Studies, and Journal of International Economics. We also have another distinguished panelist, Cedric Tillet, Professor of International Economics at Geneva Graduate Institute. His research interests are international transmission of economic cycles and policies, financial globalization, international role of major currencies, dynamics of balance of payments, and value of international assets and liabilities. Professor Cedric Tilley's works have been published in top-tier various journals, including Journal of Monetary Economics, Journal of International Economics, and International Economic Review. So now let me turn things over to Roger for his presentation entitled Recent Trends of Capital Flows in Asia. So thank you very much. Roger, please.
Yes, thank you so much, Yasu, for the opening remarks. Good afternoon, everyone, and thank you for joining. So today I'm going to present a recent co-authored paper, but before I do that, let's first go into some trends of capital flows in Asia, particularly focusing on the first quarter of this year. Yes. Next slide, please. So what we know during in March 2020, the World Health Organization declared COVID-19 outbreak as a global pandemic, and so risk aversion or investor sentiment quickly deteriorated and liquidity conditions tightened. So we can see from a measure of global risk aversion that the VIX index increased to levels that we last saw during the global financial crisis. At the same time, we can see that the stock price index for most of the economies in the region actually dropped around mid-March. But then given the tightening of liquidity conditions and deterioration in investor sentiment, policy responses were quickly put in place, which includes fiscal support, monetary expansion, exchange rate intervention, and the like. Next slide, please. So given this background, we can now see some recent trends on capital flows, particularly during the onset of the global pandemic. What we can see is that there was a large non-resident outflows in March, and this is mainly due to equity flows. So for instance, in emerging Asia, non-resident portfolio outflows amounted to around $19 billion US. But what sets this episode apart from other episodes is the speed and the scale of non-resident outflows to emerging economies. So just to compare, across all emerging economies, total portfolio outflows amounted to around $90 billion US in March of this year versus around $77 billion US during September and October of 2008. Next slide, please. Now, this portfolio outflows is now reported in the balance of payment statistics of selected Asian economies, and they have indeed report a reversal or a portfolio equity outflow. However, when we look into the total non-resident financial flows for the first quarter of the year, we can still see an inflow amounting to around $90 billion US. Next slide, please. When we look into different composition of capital flows, we note earlier that portfolio equity flows has experienced a significant outflows, but there were other components that actually increased. So for instance, non-resident currency and deposits actually increased for around 40% from the previous quarter in the fourth quarter of 2019. And this may actually suggest that investors may have shifted towards more liquid assets such as currency and deposits. On another component, when we look into non-resident trade credit and advances, we can see a sharp decline in the first quarter, and this somehow reflects trade credits in the region. Next slide, please. Then finally, for non-resident debt flows, we can see that it actually increased in the first quarter relative to the third quarter of last year as well as the fourth quarter of last year. But what is different about the debt flows at the onset of the global pandemic was that there's a significant increase in loan flows, whereas portfolio debt or bond flows actually decreased relative to previous quarters. So in summary, the recent trends of capital flows, particularly in the first quarter of the year, shows that there was still an inflow to the region. However, when we look into different compositions such as portfolio equity, currency and deposits, loan flows, they already reflect financial conditions and uncertainties during the onset of the COVID-19 pandemic. Next slide, please. So what I've shown you is actually the recent trends on capital flows. For more compositional approach, we look into the different components, but equally important is actually looking into capital flows, where they come from, which sector they come from, and to which sector they go to. In a recent co-authored paper I have with Etienne Lepere, this is what we actually considered. Next slide, please. So what we do in our recent paper is that we assembled a sectoral capital flows data set for around 64 advanced and emerging economies, including some from developing Asia. And we included all types of investments like direct investment, portfolio, and other investment. And we considered more sectors in the economy: central bank, general government, banks, non-bank financial corporations. And importantly, we also looked into other financial corporations, which in some case they call it as non-bank financial institutions. So given this data set, what we did is we looked into the different global and domestic factors that actually influence these sectoral flows. Then we look into the correlations between resident and non-resident sectoral flows. Then finally, we look into the effectiveness of sectoral controls on sectoral flows. So the importance of looking into a sectoral approach is, first, we would want to look into sectoral differences in terms of patterns as well as their sensitivities. So for instance, if one sector can be more responsive to certain global factors, whereas other sectors may not. The second important point of looking into or highlighting sectoral approach is that over the past decades, there was significant changes in the global financial system, where non-financial corporations now are becoming more active in terms of cross-border financial transactions and investment. And at the same time, other financial corporations are also driving capital flows in the global system. Next slide, please. So for the data set, our primary data set is the IMF's balance of payment statistics. However, we did some calculations of our own. We filled in some data, particularly when there is one sector data missing. We use the reported values to derive the missing sector. In some cases, we assign specific investment types to specific sectors. So for instance, official reserve, that automatically goes to the central bank, whereas insurance and pensions, that goes to other financial corporations. And for other data, we actually computed the sectoral flows data by using average sectoral weights. And we use various sources in order for us to compute these sectoral weights. For direct and foreign direct investment, we used OECD data, national source, and IMF data. For portfolio and other investment, we use the IMF International Investment Position, which is the stock version of the financial account balance reported at the BOP. Then we also use the IMF Coordinated Portfolio Investment Survey and the BIS Locational Banking Statistics. So overall, we did that. We classified that across 5 sectors for all different investment types. 73% of our 55,000 data points were actually reported values, whereas 7% were filled in data and 21% are computed values. Next slide, please. So let's look into some stylized facts that we actually noted from our data set. We can see for the full sample, resident sectoral flows, these are the domestic investors, most of which actually, most of the capital flows actually came from other financial corporates, particularly in recent years. And this is followed by non-financial corporates. In terms of non-resident sectoral flows, which is foreign capital flows, most of this actually go to non-financial corporates, followed by the banking sector. This pattern, what we can see for the full sample, clearly reflects that of advanced economies in our sample. Next slide, please. But when we look into emerging economies, the different pattern emerges. So for instance, for resident sectoral flows, most of capital flows actually come from the banking sector and non-financial corporates. For non-resident sectoral flows, most of which actually comes from or most of the largest recipient rather is actually non-financial corporates. And this is understandable that given that most emerging economies are large recipients of foreign direct investments. Next slide, please. Now we can also do that and look into different sectoral flows for different economies, particularly in emerging Asia. When we look into, let's say, China, non-resident sectoral flows, most of which actually go into non-financial corporates, then some of which goes to the banking sector. Then for India, we can see that non-financial corporates and banking sector receive largest amount of capital inflows, whereas for ASEAN 4, non-resident sectoral flows mostly go to non-financial corporates. But we can see for ASEAN 4 that the government sector or the public sectors also receives a huge amount of foreign capital inflows. Next slide, please. So when we look into the covariates for this resident sectoral flows as well as non-resident sectoral flows, we highlight some findings. So for instance, global liquidity, an increase in global liquidity is significantly associated with higher private sector flows going into the banking sector, non-financial corporates, as well as other financial corporates. An increase in VIX tends to lower inflows to the banking sector and other financial corporates, whereas an increase in domestic GDP increases the banking sector flows. But what is different from our paper is that when we look into other financial corporates, an increase in domestic GDP actually leads to a decline in outward investment for other financial corporates. Then for non-resident sectoral flows, we can still see that the same results follow, like for global liquidity, the private sector flows coming into the banking sector, non-financial corporates, and other financial corporates. For VIX, it is only the banking sector, whereas for an increase in GDP growth, we see an increase in the banking, non-financial corporates, and other financial corporate sector. But for the general government sector, we see an increase in domestic GDP leads to a decline, or is significantly associated with lower government inflows, and that actually reflects capital inflows to the public sector as being counter-cyclical. So overall, our results for the covariates imply that sectoral flows, they exhibit varying responses and sensitivities to global and domestic factors. But what differentiates our results from other studies is that we were able to include more types of capital flows, as well as we consider other financial corporates. Next slide, please. So we did several sensitivity tests for our baseline results, and then we also did some extensions, such as looking into advanced and emerging economy splits, debt and equity splits. We look also into net sectoral flows. Then we also conducted some sensitivity tests on those extensions. Next slide, please. Now, the second, after we looked into the covariate, we then move into looking into the correlation between resident and non-resident sectoral flows. And the motivation behind that is that a real business cycle model, they tend to predict that higher productivity tends to increase expected returns, leading to higher non-resident inflows, but lower resident outflows, meaning resident and non-resident capital inflows, they should be negatively correlated. But existing studies actually show that there is actually a positive correlation between the two, and there were several explanations that were provided. Now, it remains important for us to actually understand why there is a positive correlation between the two, because somehow this reinforces global imbalances. Our contribution to this strand of literature is to look into more sectors that includes more types of flows. Next slide, please. Yes, so when we look into the correlations, these are actually conditional correlations. What we find is that the co-movement between resident and non-resident other financial corporate sectoral flows, they tend to contribute to the observed positive correlation between gross inflows and outflows. So our results from table 3 and 4 would show, let's say, that non-resident flows going to the banking, NFC, and OFC are positively correlated with resident flows to the other from other financial corporates, which is the last column. And the same is true when we look into non-resident sectoral flows. We see that resident flows from the banking, non-financial, and other financial corporates is positive and significantly correlated with non-resident inflows going to other financial corporates. Next slide, please. Yes, then finally, what we did is we wanted to understand what will happen when we change some global factors. How does this impact this positive correlation? So what we did is we interacted, let's say, sector X inflows with VIX, and then we looked into the marginal effects. And what we find is that as risk aversion, let's say a measure of global risk aversion increases, the positive correlation increases for the banking sector and the general government sector, whereas it tends to decrease or even turn negative for non-resident banking flows as well as for resident non-financial flows. So in summary, this extension of our co-movement analysis suggests that as, let's say, a global factor increases, there's sectoral flow, the positive correlation between sectoral flows may either strengthen or weaken. So with that, I'll turn it over to my colleague Etienne, who will discuss the impact of sectoral controls on sectoral flows. Etienne?
Right. Can you see my screen?
Yes, we can see it.
Excellent. No, thanks a lot, Rogelio, and thanks for the ADB to organize this this wonderful webinar. I'm very glad that I was invited to co-present the paper that I wrote with Rogelio. It's a different background, institutional background, different colors, but it's very much the same paper. So this is the follow-up of what Rogelio was just presenting you. I'm gonna actually look into more the capital control side and have a bit more policy discussion based on some of the findings of the work we also did at the OECD. So we start first with the need for more refined data on capital control, and this is gonna be an issue that most of you in the audience are aware of. The research on capital control is plagued with many data issues. The first one is that there is no clear definition of capital control. There is no granularity by type of instrument most of the time. There is no measure capturing well the intensity of capital control action. And when you have slow-moving indices, you end up with small number of observation when you look at the changes in capital control. So what we did is that in previous work at the OECD with a co-author, we created a new data set on capital control adjustments. So we are trying to move beyond slow-moving indices to tightening and easing measures. We have a more comprehensive coverage, 2,300 adjustments for 51 economies from 2000 to 2017. We have a split by instrument, so we're able to say this country X has tightened capital control on portfolio equity inflows or on portfolio debt outflow. And so what we do with Rogelio in the current paper is that we extend this data set to include a sectoral split, meaning the capital control applies to which sector specifically. So first I wanted to do like a parenthesis on the intensity of capital control and the need to capture both the extensive and the intensive margins of control. So in a top index that is very widely used, Fernandez classify each type of capital flows into whether the operation is restricted, and he assigns a number 1, or 0 if it's free. What we do, following work that is also done in the macroprudential policy literature, is that we code as +1 if a restriction is introduced, +1 if a restriction is tightened, -1 if a restriction is eased, and -1 if a restriction is removed. And so I'm showing you here the example of India. So an index of capital account openness is the yellow line and the right-hand axis. So you see that from 2000 to 2017, it seems like India has been fully closed, almost fully closed during all this time, without much variation in its capital account policy. Our data is actually showing with the gray line a cumulative and gradual easing of capital account policy in India, with many, maybe minor, maybe more significant actions towards easing of the capital account. So that captures both the fact that some of the existing restrictions have been eased, but also some restrictions were completely removed. And so with Rogelio, we're adding a sectoral breakdown to this data set on capital control. A sectoral breakdown is neither obvious nor trivial. Controls are usually applied to specific transactions rather than specific sectors. But actually, when you look into the data more, you realize that major categories of control appear to fit better a sectoral classification. And I'm going to give you a few examples here. Supervisors usually put limits on outward transactions by banks, pension funds, or insurance. And these are horizontal restrictions, meaning you have a limit to the percentage of your portfolio that can be foreign assets, without regards to the type of assets that there is. FDI restrictions are sectoral by nature, and there you can have a look at the OECD FDI restrictiveness index, where you really have a score of openness for every single one sector of the economy, and a much more granular breakdown than the one we're using here, with the openness of the manufacturing sector, the openness of the aviation sectors, and so on. But also controls on natural persons or controls on NFC external borrowings usually do not apply to a specific transactions, but they apply to a specific sector directly. So what do? We reclassify the 2000 plus control adjustments, whether they apply to the OFC, NFC, bank, or to all sectors. We classify based on the resident sector, so that means it's the investor sector for outflow control, and it's the investee sector for inflow control. And the number of capital control adjustment is summed up in each year within each sectoral category for each country. So again, a few stylized facts. We have here controls on non-resident flows, so on inflows. On the first chart, you have the yearly adjustments. If it's above 0, it's a tightening. If it's below 0, it's an easing. And below, you have the cumulative adjustments. So you see that overall, there has been a movement towards liberalization in our sample for all three sectors. But there has been, after the crisis, a few more tightening actions, and that reflects the debates on the usefulness of capital controls that has been triggered after the crisis. For resident flows, we see a much more striking easing of capital controls, especially on the OFC sector. And actually there it's very well known, the fact that supervisors of the insurance and the pension funds have moved out of a residency-based approach to supervision to a more risk-based approach to supervision. So they have basically removed all the limits on the percentage of foreign assets and replaced by a risk-based, risk-type approach, which doesn't relate to whether the asset is foreign or domestic. So what do we do in the empirical analysis? We basically take the same model that Rogelio was showing you, and we're adding whether the control has any effect on the sectoral flows. This is important because most of the literature find mixed effects on the effectiveness of capital controls in reducing the volume of the flows. We take a narrower focus to emerging economies and to tightening actions, because we're really interested in the effectiveness of tightening actions for emerging economies, including those in Asia, in reducing sectoral flows and not on the more structural trend of capital account liberalization. We take lagged control because of endogeneity and potential delay in the impact. So what do we find? I'm just showing you an abstract of the table. Again, you have results with banking sectoral flows, NFC sectoral flows, and OFC sectoral flows as the dependent variable. And you see here that controls on inflows to NFCs and OFCs are associated with lower flows to these sectors. We do the same on the outflow side, and we don't find any significant impact there. Again, there is various issue with the literature on the effectiveness of capital control, so we try a few sensitivity tests, which I'm not going to dwell too much into. We are trying to address issues of endogeneity, of the construction of our capital control variable by using binary sectoral controls. We're also trying to add the contemporaneous and lagged sectoral controls, and only sectors applied to other sectors. Basically, what you can infer from these many tables is that we don't find any effect on the outflow side still in any of the robustness checks. But on the inflow side, the results are robust to a wide range of sensitivity tests. Most of the time is the NFC and OFC flows that are shown significant. And then we do a final last step. We wanted to have a quick look at the circumvention of capital control. There has been a wide literature on also macroprudential policies that shows that when a measure is applied to banks, macroprudential measure, then other sectors tend to fill the gap that is left with the reduced, for example, credit growth. And so what we do here is that we see whether, for example, controls on bank see more flows towards NFCs and OFCs and the like. So basically whether the two other sectors in the economy that we're looking at are seeing increased or decreased flows after the tightening of control in a third sector. We don't find any results on the inflow side this time, but we find some results on the outflow side, where tighter controls on resident NFC flows are associated with an increase in bank and OFC flows, pointing to potential circumvention. So this is a very crude way of testing circumvention, but we wanted to have a quick look in the last part of the paper, and we do find some evidence of circumvention from the banking and the OFC sector. So overall, our paper is finding that sectoral resident and non-resident flows exhibit varying responses and sensitivities to global and domestic factors. Co-movements between resident and non-resident OFC sectoral flows contribute to the observed positive correlation between gross inflows and outflows. And finally, tighter capital controls on NFC and OFC appear to reduce non-resident inflows to these sectors. So we believe that with this sectoral approach, having a full vision of the financial account and having a more detailed breakdown of sectors in the way we did is shedding some lights into the wide range of research that there has been on capital flows. And I wanted to end up to put a full circle to shed some lights from recent OECD research that that we've done during the COVID, and start with some lessons from recent history for COVID-19. We believe that our research that I just presented you has some policy implications in the type of toolkit that emerging markets can use in different capital flow extreme episodes. And we've seen the large sudden stop that there was in during the COVID period. So what we did is that, as you can see on the table, we've tried to see in the history how countries have responded to episodes of stops and episodes of flights. So you see capital controls on inflow, capital controls on outflow, macroprudential policy, and currency-based measures. And each time we split whether it's easing or whether it's tightening. So basically, we don't find any clear pattern on currency-based measures and macroprudential measures in whether countries will ease or tighten during stops or during flights. But we see that easing inflow controls has been much more prevalent in terms of stops and flights, and easing inflow control in more country case studies have been shown helpful, while outflow controls have been rarely tightened because they're typically seen as last resort tool in crisis. So what has happened during COVID, based on this lesson, is that we've seen that FX intervention has been the first line of defense, both in the spot and the forward basis. There has been relaxation of inflow control, and with our sectoral lens, we can still see some sectoral perspective there. Peru has reduced reserve requirements on liabilities to non-residents, so this is only applied to banks, and so it would be classified in our data set as a sectoral bank sectoral control. India has eased limits on foreign portfolio investments in corporates and government bonds, and China has eased the ceiling on cross-border financing. We have seen no reintroduction of outflow control. There has been some easing in Argentina on the controls that they had put in place in the last 2 years, and currency-based measures have been mainly eased with some tightening. So you've seen that it was adjusted a lot. FX reserve requirements were eased in Indonesia, Turkey, and Peru. FX derivatives caps were eased in Korea, but tightened in Turkey. FX liquidity ratio were eased in Korea, Sweden, and tightened in Hungary, and FX liability levy were eased in Korea. So all of the easing with more an aim to kind of increase the liquidity that is exiting the market otherwise. If you want a bit more details on these measures, you can have a look at the OECD report to the G20 IFA that it's available on the slides, but also on our website. So I'm going to end up there and look forward to the discussion. I wanted to tie a bit back the discussion to the current. And thanks a lot for your attention and for inviting me.
Okay, thanks, Roger. Thanks, Etienne. Can we now invite two distinguished panelists to a discussion? We'll have Frank Warner from University of Virginia, and also Cedric Thiel from the Graduate Institute of Geneva. Well, can we have like maybe just a 5 minutes opening sort of a statement or a short, like a discussion based on the presentation by each panelist? So Frank, would you like to start first?
Sure. So, okay. So you want me to present this or talk about Roger's and Etienne's presentation?
Well, you can actually have your own presentation if you like, and please, if you can relate what you sort of discussed to what they have presented, that will be also great.
Mm-hmm. Okay. All right. So it's wonderful to join this. I'm very happy to be here. Let's say, and I'm just going to very quickly talk about recent work that I've been doing on the natural level of capital flows, which we call KF star. Next slide, please. This is ongoing work with two of my favorite co-authors, John Berger and Veronica Kuktak-Warnock. It's an MBR working paper, and we've updated it just last month. And what we're going to be very precise, what we're going to look at here is the amount of portfolio, that is equity and bond inflows that a country receives. And when we talk about KF star, or the natural level of capital flows, that's going to, just keep in mind, that's computed as current period rest of the world private savings times a lagged portfolio weight, and the lag that we use is a 5-year moving average. So just keep those two things in mind as we go through these slides. Next slide, please. So the question that we ask and have been asking for a long time is, can we predict future portfolio inflows? And when you look at these graphs, so these are just 4 countries, Japan, China, India, Indonesia. At any one point in time, can you predict what's going to happen in the future with these inflows? In these graphs, these are quarterly graphs in billions of US dollars. Keep that in mind as well. You look at these graphs, and they're one thing that you might say is it would be crazy to try to predict these things, and I think the literature has shown it's very difficult to, but that's what we take on. Next slide, please. And so these are the takeaways, right? So of the current paper, you have all the takeaways right here on one slide. One is that portfolio inflows, those graphs that we just showed, oscillate around this thing that we call KF star. And the deviations of those flows from KF star are transitory. We have strong reversions back to KF star over a 1 to 2 year horizon. The explanatory power of KF star is very good and much greater than traditional push and pull factors in explaining future flows. It also, KF star predicts 6 quarter ahead sudden stops, as well as next year's equity returns. And when we apply this to the crisis, so first we try to learn from the GFC, and if we used our measure up to the eve of the GFC and then asked the question, does it help predict what happened to flows by country during the GFC? And the answer is yes. And then we do the same sort of analysis just prior to the pandemic, and that analysis, which I'll show in a couple slides, suggests that any sharp decreases in portfolio inflows during the current crisis will be short-lived. Next slide, please. So these are just the graphs that we started with, but now with our measure of KF star on the graph as well, the slow-moving blue line in each graph is the KF star, and that is the level of quarterly capital flows that we would expect based on this natural level of capital flows. So for Japan, for example, if you look at, and these will all go through Q1, the actual flows go through Q1 of 2020. Our KF star, we haven't updated yet, but it's through Q4 of 2019. So if you look at the last data point for KF star for Japan, it suggests that Japan can expect to receive about $50 billion worth of portfolio inflows each quarter. Sometimes, some quarters it's above that, some quarters it's below that, but what we expect is $50 billion per quarter, roughly. And you see the different KF stars for different countries. What you can see from these graphs, just with using your eyes, is that actual flows oscillate around this KF star. And then the paper is all about showing empirically that that's true, right? So what you see with your eyes is true empirically as well. Next slide, please. These are then getting at two different things. So one, actually two sides of the same coin, I would say. The flows will revert strongly back to KF star over a 1 to 2 year horizon, and we get a very strong explanatory power as well, just using KF star. So on the left graph, I put on that graph the line of -1. if you get a coefficient of -1 on the type of regressions that we're running, that would mean that the current gap between actual flows in KF and KF star is exactly undone, right? So that is, we have a very strong predictive power. It's exactly undone at this forecast horizon. And if you look at forecast horizon of 7 quarters ahead, the little line within each box is the median beta coefficient for these 30 emerging markets. It's very close to -1. So that is 7 quarters ahead. We've got really strong predictive power, and not bad predictive power once you get to 4 quarters ahead, 5 quarters ahead. The right graph is just from the same regressions, the R squared, and you see that the deviation from between the actual and KF star, even just 1 quarter ahead, gets you on average almost a 40% R squared, and the maximum R squared on average is about 8 quarters ahead, 7, 8 quarters ahead. So that's why we say 1 to 2 years, this has really strong predictive power. Next slide, please. On sudden stops and equity returns, if we think about 2 conditions, so one is the gap between flows and KF star is large, and by large I don't mean really large, just 1 standard deviation above its mean, and global growth is strong, again just 1 standard deviation above its mean. Probability of sudden stops within 6 quarters is 38%, which is pretty large probability. And the intuition there is that when we have strong rest of the world global growth, where we've got strong rest of the world global savings, that means that KF star is increasing. If actual inflows are increasing even more, we get a high probability of a sharp reversal, right? A sharp decline in future flows. And these same conditions, the strong inflows relative to KF star and the strong global growth, predict a 13% decrease in the country's MSCI equity returns next year as well. And so the predictive power is really that when you have higher than expected capital flows, you're very, very likely to get a reversion, right? That's what our measure is picking up. Next slide, please. Now, during the crises, just to try to learn from this, so the left panel is, if we look, so on the horizontal axis, if we look at the gap between actual flows and KF star, so what we're calling the KF star gap, just prior to the GFC, the more positive was that gap. So that is, the higher flows were relative to KF star just prior to the GFC, the larger was the decrease in flows that country received during the GFC. And this is true for any sample we look at, even if we get rid of that one outlier, which is Hong Kong, which just makes the graph look nicer, but still you get rid of Hong Kong, you get the same result. Now the right graph, we look at the eve of the pandemic. So if we look at the gap, the KF star gap in 2019, what was going on then? Well, most countries were actually having flows lower than KF star in the year 2019. So the bulk of those observations are less than 0. And there are only a few countries that had higher than KF star flows in 2019. Within Asia, there's just a few countries, and these are not exorbitant, right? So this is, so 0.05 would be 5%. The gap is 5% of GDP. I think for China, where we did see very strong flows in 2019, the gap is about 0.55%, so less than 1%. So these positive gaps aren't strong at all. And that suggests to us that going into this, we weren't seeing excessive capital flows. And therefore, from this analysis, we don't expect large drops, or at least if they are large drops, they should be short-lived. Next slide, please. Right, and so this is, I think, my final slide, and just reiterates what I just said. We think that this slow-moving supply-side construct, KF star, the natural level of capital flows, is actually very, very helpful in predicting future flows. And the predictive power comes from when flows are high, they're very likely to revert, right? And revert to what? We think KF star is a good candidate for what they're reverting to, and it has a lot of nice features. And I'll stop there. Thank you.
Sion, please unmute your microphone.
Sorry. Oh, thank you, Frank. That was very interesting presentation. I myself, I have quite a few comments and observations, but let me go to Cedric for his opening statement first, and then we will have a moderated panel plus the Q&A sessions. I would also like to encourage any participants, please do type your questions in the note box, and then we will be able to also include those questions in the Q&A session. Okay, Cedric, do you have any comments, feedback on their presentations, or you have your own?
Yeah, thank you, Sin-Young. So I have a few opening remarks with these slides, and then I will have some questions for Rogelio and Etienne's presentation. But first, let me thank you for the opportunity to discuss this topic. It's a very relevant topic, and now we're in a period where we have seen massive capital flows. I mean, capital flows are always volatile, but they're particularly so now. So next slide, please. So what we're seeing is a massive retrenchment, and it's much bigger than what we had in the global financial crisis. What I put here is a chart taken from a recent IMF paper, and that focuses on flow coming in for bonds, okay, which is the category where we're seeing the most volatility right now. And you start at zero at pre-crisis point, and the blue line shows you what has been going on now. Okay, and the time horizon is in weeks. So you see a massive decrease. Compare this with the taper tantrum of 2013 or the global financial crisis, and we clearly see we're just simply not in the same ballpark. So can we learn a bit more here? And I'd like to put two main points forward. The first one, drawing on this recent research by El Fayyoumi and Martina Henge, is that capital flows have actually been quite responsive to country-specific measures. Okay, so let me go to this first point. Usually we think of when we have a crisis, the panic, that capital flow stops broadly for everybody. Well, there is a clear global component, but it's far from the whole story. There's a high level of heterogeneity. Okay. And this research by the IMF look at how flow at the weekly frequency react to the extent of epidemic and the policy response in the various countries. So the author looks not only at portfolio flow at a weekly frequency using the standard EPFR data, but they also look at the price, if you want. So EPFR is like the quantity, and any supply-demand diagram, you also want to look at the price. And the proxy for price here is a CDS spread. So what do they find in a nutshell? If you're in a country where the epidemic gets worse, you get higher cases per capita, you initially face a drop in capital flow coming in. But what is interesting is this drop is short-lived. After a few weeks, and actually quite rapidly, capital flow go back up. So that sounds good, but don't get carried away. They go back up at a price. The CDS goes up. So what you have is in your country, you're facing a big epidemic, you need foreign financing. Well, you'll get it, but you have to pay for it. Now, what happens when you have the policy response? If you have the lockdown measures, if you basically get on top of things and start locking down to prevent the epidemic, initially capital will stop coming in, but then going back up. So you have this same V shape, if you want, pattern. However, the price is very different. What they show, the author shows is CDS spreads go down. So this is more of a pattern of the market saying, okay, you're getting your act together, you're reacting, so you're a country in which we have confidence. Bit of a similar pattern when countries take a fiscal stimulus measure to limit the macroeconomic damage, then actually you draw money in, even in the short run. and you don't have to pay a higher price. If anything, CDS go down temporarily. Okay. This effect doesn't last, but it's at least going the right direction. An interesting aspect is monetary policy has very little effect. So what the policy that matters is policies that are really targeted at the epidemic. Do you get on top of things by locking down, and do you prevent second round of damages by fiscal policy? And so the message that one can get from that is, if you have a policy response that's aggressive and well targeted, you restore confidence in a way. The investors are willing to come in, and they won't ask you for a higher price. You, if anything, get a price discount. For the fiscal stimulus, this is short-lived, so it may well be that in a more medium run, with your debt going up, then markets may be less forgiving. So that was my first point. Next slide, please. My second point is to look at the safe haven pattern. So in global crisis, what we have is a flight to safety. And usually it favors the US because the US Treasury market is hard to beat as the big liquid safe asset. But now we start actually seeing something quite different. Okay? And so to set the stage in this slide, what I show you is a pattern during the global financial crisis, 2008, 2009. What you have on the left are the exchange rates. So the green line shows you the dollar exchange rate index. So up is an appreciation of the dollar, and that's for a vis-a-vis advanced economy. The blue line is the same exchange rate, but vis-a-vis emerging markets. We clearly see that when the crisis hit, so the VIX, which is the red line, goes up, you have a flight to safety of the US market, and the dollar appreciates. And if we look at what assets foreigners are buying on the right side, here I look at the TIC Treasury data, and I look at the net foreign purchases of US government debt. So a positive value means foreign investors are buying treasuries, and we clearly see that this went up. Okay. So the global financial crisis, the US was a safe haven. What about now? Next slide. Well, not so clear. Okay. So if we look at the situation now, we had a VIX increase again. Okay. Now it's been going down. Let's look at the exchange rate. The blue line shows you that the dollar did appreciate again vis-a-vis emerging currencies, but not vis-a-vis advanced ones. You see the green line is actually no clear movement. So it's not so clear that the US is a safe haven. I mean, to put it another way, emerging market currency weakened clearly, but not just vis-a-vis the dollar. Okay, so, if you take the ratio of the blue and green line, so to speak, what you'd see is that emerging currency also weakened vis-a-vis the euro, Swiss francs, and other advanced economy. How about flows into US treasuries in the right panel? Well, they actually went negative. Okay, and so for countries, if anything, pulled out of the US treasury. What this likely reflects to a large extent is central banks drawing on their foreign exchange reserves and just liquidating US dollar. But that's not the whole story. So it looks like the US is not such a safe haven. Likely that reflects the fact that the US is itself very much affected by the pandemic, and the policy response has been, shall we say, questionable. Okay. Now, whether this will last or not is open. Now, what about other safe haven? Next slide, please. So one small safe haven is Switzerland. And here I illustrate the pattern in Switzerland. And again, the left chart shows you what went on during the global crisis, and the right chart, what is going on now. So I again put exchange rate, put index of the Swiss franc vis-a-vis the dollar in green, and vis-a-vis the euro in blue, and going up means the Swiss franc strengthen. What you see during the global financial crisis is a Swiss franc increase. Now, well, how about quantities? So the Swiss government debt is far from as liquid as the US one. If anything, Switzerland, I would argue, has too little government debt, but that's another story. But however, what did foreign investors buy? They basically buy bank deposit that appreciate the Swiss francs, and this has led the Swiss National Bank to intervene massively. And what I put here as a monthly measure of FX intervention is the changes in banks' reserves at the SNB. So essentially, that's a non-cash part of the monetary base. It tracks actually foreign exchange intervention at a quarterly frequency quite well. Well, you clearly see that the Swiss National Bank has intervened a lot during the global crisis. And if you look at the right, it is also increasing reserves a lot currently. Okay. To give you a sense of scale, bank accounts at the SNB are now about 660 billion Swiss francs. That's close to the Swiss GDP. So you have a massive safe haven flow into Switzerland. So safe havens have been affected right now, just not the big US one. And let me conclude, going beyond this remark, by giving some remarks based on the two presentations we had. So on Rogelio's talk, what I found very interesting there was the effect of the VIX on the flow, which is what we'd expect. I would be curious to see what about other global factors. For instance, Yung-Chang Shin and others at the BS point that if the US dollar appreciates on a broad basis, this is actually a tightening of global financial conditions, especially relevant for banks. Another point that I found interesting was the impact of commodity prices. High commodity prices pull money in for non-financial corporations, but the effect is negative for banks. I'd be curious to know whether this effect is particularly pronounced in commodity exporters. So is it the case that when this country's prospects go up, then foreign investors want to invest in the local mines, and this is so they go directly and don't bother going through banks. Turning to Etienne's presentation, so it was very interesting database on capital controls. I found it very striking the effect on banks is not there. It's really on non-financial corporation. Also on other financial companies, however, there the magnitude and statistical significance are weaker. So it really looks a story about non-financial controls, corporation. And what we have is if you tighten controls on non-resident inflows, it works. So they go down. I'd be curious to know whether you have a diversion to other countries. And this you could control by including in the regression control measures in neighboring countries. And neighboring can be regional neighbors, or there are measures of neighboring depending on trade connection. And what you may well have is if my neighbors tighten controls, I get the money. Okay? And I think that would be relatively easy to test in your sample. What is interesting is the effect on the resident flows are very limited, and for resident flow, we see evidence of getting around. So what this could show is if you tighten controls of money coming in, well, maybe for investors, just go to your neighbor. So they don't really care in a way that you close down. There's always another market. If what you want to do is prevent your own resident from going away, well, they want to go away for some reason, and they're going to put a lot of effort at going away. So your controls won't really work, and going around activities will be much more pronounced. So that would be my initial remarks on the two presentations, and I look forward to the discussion. Thank you.
Thank you very much. I really thoroughly enjoyed all three presentations. I felt like, in fact, we should have started with Frank's presentation first, because it does show a bit more of kind of like an equilibrium level of the capital flows. The question is, if there is kind of like long-term equilibrium, what Frank and then co-authors mentioned as a natural rate of capital flows, there might be a bit the kind of like in a business cycle or like a cyclical kind of way of these inflows and then outflows that do allow us to help predict some, maybe the natural or like maybe more balanced sort of capital flows to the country. And then Roger and Etienne's study, in fact, asked the questions like, in any case, these capital flows, if it is going to be like inflow, outflow, it is driven by certain types of investors. right? Etienne and then also Roger look at the types of domestic investors versus the types of all the foreign investors, and how their different sort of portfolio the preference or incentive for investment really drive these differences in inflows and outflows, and followed by also the Cedric's a lot of also very insightful comments about what's happening during the crisis times. I think everybody really still continuously explore the patterns of capital flows during and after the pandemic. Especially in March, we experienced a sudden stop again in Asia. And we have seen this sudden reversal in especially portfolio inflows to emerging Asia. While they have recovered and then returned by end May and in July, following very progress, in a way, like a very aggressive policy stimulus, we are going to see lackluster economic growth, and the uncertainty still continues. Are we headed for another reversal in capital flows? I know Frank mentioned that given the previous capital flows to the region, it's natural that we see a quick comeback of capital flows, but we are actually expecting much weaker growth, and there's a much higher uncertainties, even probably after the pandemic. So the countries will expect a fall in capital flows below their natural level. Do you think there is a possibility that that sort of equilibrium level of capital flows adjusted downward? What do you think?
Yes. So the equilibrium, so the natural level of capital flows will come down if global growth slows, because that will mean, all else equal, that we have less global savings, right? And the global rest of the world savings is really, and this goes back to Cedric's work, right? And so everything that if this was a full presentation, then I would spend a lot of time talking about Cedric's work with Eric Van Wynkoop from 2010 and 2011. But the basic idea is if we have a fall in global growth, we have a fall in global savings, there's less money available for the capital flows. And so yes, the KF star will come down a bit, sure. I think more generally, what we need to take from this research is that there is some underlying level of capital flows, that is, if you want to call it equilibrium, if you want to. I know Cedric is very particular about that word, so maybe we should just call it some underlying level of capital flows. And John, Veronica, and I trot out one possible natural level. There could be others, but we should keep in mind that there is some natural level that the flows seem to be oscillating around. That would suggest in the current period, when we've seen sharp drops in capital flows, that we should recognize that they're not likely to be permanent, right, or even long-lasting. Where we see long-lasting deviations from the natural level of capital flows is in the advanced economies that have conducted unconventional monetary policy or had negative policy rates. Those few countries, and there are not that many of them, they have long-standing or persistent deviations from KF star. At some point, I'd like to be able to comment on Rogelio and Etienne's work as well, when you want me to.
Okay. Well, in fact, Roger and Etienne, you have noted that there is a strong increase in the non-financial corporate that are driving these capital inflows and outflows, because you are looking at, like, you're showing actually the residential flows as well as non-residential flows are all now largely driven by non-financial corporates. In fact, when you're talking about the emerging market economies, there's just the addition of the banks. But when you talk about these strong growth in by non-financial corporates, like, do you see any implications for policies? I mean, in terms of financial regulators, given the rapid growth of non-financial corporates, the role in the capital flows, what do you see in terms of the capital control? Like, do we have to target focus on these non-financial corporates for more stable capital flows?
Okay, so with regards to the patterns that we see for the non-financial corporates, particularly for emerging economies, I think this also reflects some multinational enterprises in the region, like, let's say, in some large economies, that actually undertake some borrowing or lending with their foreign affiliates and subsidiaries. So there was a previous literature that actually looked into that pattern, that these non-financial corporates in the region, in Asia, some of them are more involved now with cross-border lending, within intra-company lending, which our data actually captured, because some of these are actually reported in the foreign direct investment or direct investment. So in relation to your question on how these regulators can actually regulate this, well, I think that the results that we have actually show that if there would be some form of capital controls or restrictions on these flows, then it might actually be more effective if they do a more sectoral approach targeting non-financial corporates. In particular, their specific types of transaction they would actually take. I think Etienne might want to say something more with regards to that point. Etienne?
No, I mean, the core point of our paper is that you have to monitor basically the financial vulnerability of each sectors, and so we've seen that if you take only an instrument approach, then you don't find the underlying potential vulnerability that there is in an economy. In terms of the policy, I mean, there is various options there. So our paper is showing that you have some effectiveness when you're putting controls on NFC inflow. But some work is being done on extending macroprudential policy beyond banking. So, for example, in France, a case that I know a bit better, there has been some large exposure limits on large non-financial corporates that have been recently put in place. This is relatively innovative and new. And then some work is being done in Russia to extend macroprudential tools to non-bank to the non-bank financial institutions and so on. So macroprudential there, it's still very much work in progress to see whether macroprudential can be extended to other sectors. And then it's about the sectoral approach. It's about also all the circumvention stories. So some interesting work in Brazil, for example, has shown that NFCs were actually using their affiliates offshore to be able to raise funds and circumvent the Brazilian control. Looks like you have to take a consolidated approach to NFCs when you're looking at the vulnerability and figure out which policy tools would be most useful.
Okay. Well, thank you. In Cedric's presentation, what struck me a lot is the flight to safety using the U.S. Treasury bonds during the GFC. Yeah, and then now this time, perhaps the attraction of the U.S. Treasury bonds might have declined, but this might not be really reflecting, the losing sort of attractiveness of the U.S. assets. It might be most because the debt levels in the U.S. economies significantly rising. Debt levels are rising in both advanced and emerging markets, including many in our region. Actually, the rise in the debt level has been even the concern before even we are, going into this crisis. Now, with the pandemic, many countries have introduced a very, strong sort of fiscal stimulus, and they have to fund these new sort of stimulus. And we are expected to see more debt, especially in the, the public sector. What do you see as an impact of this, pandemic and associated policy responses on cross-border debt and holdings and then liabilities, especially? And are we? Is the U.S. Treasury bonds attractiveness is now disappearing because of high debt levels in the U.S.? What do you think, Cedric?
So I think that it's an interesting question, Nami. One of the big themes in international macro in recent years has been the so-called safe asset demand. So there's several papers that investor. We don't have a scarcity of assets in general. We have a scarcity of safe assets, things that keep their value even in a large crisis. And this explains why yields of government debt in advanced economy have been so low. Now, what we have now, when you have a pandemic, you have a big drop in GDP and consumption. So your savings will tend to go up, and if people want to park it in a safe asset, government debt looks good, and that could be even government debt outside the standard US, Europe. So it could be that in the short run, the pressure won't be there. What is going to be interesting is what happens when things calm down a bit. And there, I could see regional differences emerging. So Franks and Carter's research is a very nice paper, and the benchmark they have that you get your usual share of the world saving is a very nice one. I'm not going to quibble on whether we call it an equilibrium or not. What would be interesting now is we have a lot of regional heterogeneity of the severity of the pandemic, and actually Asia is doing relatively well. So in terms of getting the epidemic under control, where other regions are more struggling. So could it be that Asia emerges as a relatively safe region in the world? And in which case, that would mean that the spreads on the government debt in Asian countries could remain contained. It's a big if, that these things are very hard to predict. Now, the extra round, it would be to say, what does this imply for capital flow? Well, say that if we think that Asian countries have really gotten their act together much more than the rest of the world, so investors want to go invest in Asia, and Asia, the whole becomes a safe haven. Fine. What this implies, however, is your currency tend to appreciate. I mean, in Switzerland, we know this all too well. Switzerland is safe, super safe. Currency comes in, and then we see the Swiss francs appreciating a lot. We get imported deflation, the exporters screaming, etc. And the authorities say we cannot let this happen. So what if in Asia, the policymaker decide that they want to recycle out these capital inflows? And there we get to the usual story. Anything that happens in international macro when there's a crisis, the money ends up in the US. Because what you have there, you will look like a very liquid, relatively safe asset, which could in the end be the treasury. So it could well be that at the end of the game, and this may take several months, then the money will go, in any case, to the US. At which exchange rate, that we'll have to see. So I think we could see a very contrasted geographical pattern of capital flow and appreciating pressure. And to come back to your last point, what does this simply apply for government debt sustainability? So in advanced economy, be okay. I mean, there was this famous paper by Olivier Blanchard that the interest rate on government debt is lower than the growth rate. So, the debt to GDP ratio goes down by itself. I think this is true for advanced economy. I've looked at Switzerland, which is definitely true. It's not so clear that it's so true for the rest of the world. And my colleague Charles Wiplosch has written, for instance, on that. So we could have a situation where this low interest rate remains valid for relatively safe Asia, but for other emerging countries, now the pressure is not there, but it could come back very quickly, and we could have sovereign debt crisis emerging there.
Thank you. It's quite sobering. In fact, we have a number of questions from the floor. So first, from Yasu to Frank, would it be possible, or does it even make sense to construct sector-specific natural rate of capital flows?
Yasu, I haven't thought about that yet. So I think that there's a lot of great work to be done on sectoral capital flows. And I think that picking up on something that Cedric mentioned, thinking about global factors, all the discussion these days about global factors implies some sectoral story behind them. And I think you guys have a big opportunity to apply what you're doing to try to unpack what really is it about the dollar index as a global factor. If I think about KF star from a sectoral perspective, it becomes much more difficult, right? So I'm really, as I said before, leaning on Cedric's work from a decade ago. And in that, I'm thinking about household savings going into portfolio securities.
Can we maybe then move to Roger and Etienne in the meantime? Do you see any possible interactions across these different sectoral flows, like a non-bank and then the non-financial corporates and then banking sector?
Yes, actually, there could be when we did the analysis on correlations, co-movements among different sectors. When we computed the correlation, those are actually conditional correlations. We've already included other flows in other sectors. So basically, that would actually tell you that, let's say, an increase in one sector would actually have also a positive correlation with an increase in other sectors. So we have included that kind of analysis in when we looked into the co-movements between different sectors in what we have actually presented a while ago. Etienne, would you want to add to that?
No, not much, except that, yes, the metrics of different sectoral flows shows you that indeed all the private sector flows tend to co-move together. It's not simply the specific sector inflow and outflow that are correlated, but all the inflows to the private sectors are correlated, and all the outflows from specific sectors are correlated too. So definitely all of these co-moves, and that's why the global factors are impacting similarly every single one of the private sector.
Okay, well, I think this is kind of related, and then a more specific question from Jungwoo. What is the underlying sort of story behind the positive correlation between the resident, non-resident flows for non-financial corporate? But what drives the negative relation when these are interacted with VIX, the volatility index?
Yeah. So that's a very interesting question. The story behind the positive correlation between the two, there are a lot of studies that have looked into why inflows and outflows can be correlated or positively correlated. There were some who would look into the role of financial globalization. There would be other papers that also look into, let's say, financial frictions in the economy. And Cedric co-authored a paper on that, on another reason why there could be a positive co-movement within it, and that pertains more to optimal hedging. So there were several both empirical and theoretical explanations on why we observe that positive correlation between resident and non-resident non-financial corporate flows. But with regards now, when we did the interaction with VIX, at some point, our interaction actually shows that it actually decreases because the chart that we've shown is going down. But indeed, at some point, this actually reversed. I mean, there was at some point where we would, instead of seeing a positive correlation, it actually turns into a negative correlation between the two. So that is something that we are also, we would like to actually move and look into in more detail. But the downward sloping graph or marginal effects that we've shown would actually just indicate that at some point the positive correlation decreases or it weakens, and then at some point it actually turns into a negative correlation. So that's something that we would actually would look into more. Yes.
Okay. Well, Frank, welcome back.
Yeah, sorry about that.
What you started. There is an additional question for you. In fact, this is similar to what I raised earlier. What do you think is the role of these different types of investors? Like as Roger and then Etienne mentioned, in these banking like institutions, central banks. I mean, these are sectoral sort of patterns of different types of investors. Will they affect the natural capital flows?
Sure, they'll affect them. I mean, mechanically through the lagged portfolio weights, right? So they'll definitely affect them. I think again, it is very important to think about the different types of investors. That's exactly how I teach my MBA students to think about capital flows. And there, I think we have to also keep in mind. So sometimes we think of a lot of the portfolio investors as being the hedge funds who are hyper focused on maximizing returns per unit risk, but that's not the bulk of flows. The bulk of flows is Rogelio just allocating his wealth and trying to get some wealth preservation, right? And making decisions every once in a while and not optimizing. I'm hoping that Rogelio is not optimizing his portfolio every single day, because then he won't be working on economics, right? And so, and I'm serious about that. So we have to actually think about, there's a bulk of really long horizon investors out there, and these we have to think about. And if we think about when Cedric was talking about safe asset and safe haven flows, sure, but then as Cedric mentioned, if you're thinking about wealth preservation in times like these, it's not about returns. It's about preserving your capital. And that's very different. So I think the sectoral approach is very promising.
Thank you. For Cedric, I was actually intrigued by Roger's comment that you work with him about also the role of hedging in driving these co-movement. I actually feel also there's probably a lot of role this currency hedging will play in terms of in terms of like a flight to safety, and then how to determine even the safe assets. Where the markets are deep enough to allow hedging is going to be safe assets. So do you have any thoughts about this kind of like non-linearity they show between this co-movement between the resident and the non-resident flows? That might be related to hedging?
So that's a tricky one, because the hedging considerations drive not only your average portfolio, which would be what underlines the KF star of Frank and Carter's, but also the movement. However, these are quite sensitive to exactly which shock happens, how your correlations move. What I thought, looking at this chart with the different effect, it could be that when the VIX is high, it acts as a really asymmetric shock. Okay, whereas when we have our productivity shocks, for instance, which tend to be more global, then or even if the productivity shocks affect more one country, I get more money, I invest into you, but then this affects asset prices, and you decide to invest into me because I become a very interesting prospect. VIX is another story. It could be really something that you become very different from me. And there I would expect this positive co-movement to go down, and we go more like, I'm going to be very careful investing into you, and this, this is not mirrored so much with what's happening in my country. So that would be my hunch of what could drive this. In terms of stress, countries become much more heterogeneous in terms of their fundamentals and attractiveness, whereas more standard macroeconomic shocks, even though they can be asymmetrics, are not such a stark asymmetry. And it could well be also, as Frank pointed, in terms of stress, you just want not to lose. You don't really care so much about winning. Whereas the standard correlations are more like, well, you're playing all aspects of the games, and you win a bit or you win a lot, but it's not like you win or you lose totally.
Thank you. Well, time's running out, so I'm going to give you each just about 30 seconds to have a final word and then messages from your presentation or your fellow panelists. So can we start from Frank?
Sure, of course. So I will say, so one, I will send Rogelio and Etienne, I'll send you some comments on your paper. Two, as I said already, do think about some underlying level of capital flows, and you can call it whatever you want, but I think it's useful for everybody to think about that going forward. And three, if you take that seriously, then you won't get that excited about sharp drops in flows that last 1 month, 2 months. You'll say, okay, going forward, it should revert. Thanks.
Okay, Cedric.
Yeah, thanks. I think this whole research on the sectoral pattern of capital flow imbalances is something very promising. The challenge is to really draw a story, because the more categories you have, then you get bigger correlation table, and there's always a risk of being lost in the stylized fact. So it's really a challenge to get that. And one thing I'd be interested in the paper with the capital controls is to try interactions. So you show capital controls work on the inflows, but of course, I can imagine as a policymaker, that's fine. But what I really want is that they work when I need them. So if I have a high VIX, or if whatever global factor is going the wrong way, will my capital controls work as a way to limit the damage? Because you may actually find that they work in normal time, but when people really want to get out, there's no stopping them. And that actually will be a sobering message for policy.
Okay, Roger and Etienne.
Thank you very much. Thank you very much, Frank and Cedric, for the comments, as well as for the participants. I guess for me and Etienne, we, in a way, doing the sectoral approach is a new for us. It's like it opens up a lot of areas, a lot of considerations when we look and try to understand capital flows, particularly for our region in emerging Asia, where capital flows remains to be a policy consideration by central banks, by other monetary authorities. So this paper, what we did is, in a way, just to highlight, how we can think of capital flows in terms of different sectors, and how this can actually inform policymakers, basically, in our region in emerging Asia. So that's my Etienne. Yeah.
No, I just want to thank everyone for the comments, including Frank and Cedric. I think there is some good angles to tackle, whether there can be sectoral, KF star, the circumvention story to other countries, which has been done, but not with a sectoral approach, and the interaction with specific episodes, whether the controls work when you need it or not, are all super exciting stories that we can try to pin down as we move this paper forward. So thanks a lot.
Okay. Thank you, very much for all participants and then speakers, and especially also for Roger and then Etienne to provide this very hard work and then interesting results forward for us to be able to also comment and discuss. Thank you very much for also Yasu's intriguing opening remark and Frank's very intuitive and then again very intriguing presentation, and then Cedric's insightful policy analysis. So thank you very much for all to participate in our webinar. We look forward to seeing you in the next webinar. And if you have any comments, suggestions, do leave the message even after we finish. The next webinar is supporting SME internationalization in the new normal in September 1. Thank you.